Hi, everyone. So I'm with Sachin Khajuria, who has written a book called 2 and 20 about private equity. And if you're anything like me, you know very little about it. And a lot of what I know about private equity are some of the words that Warren Buffett has used about private equity. And he's been, I guess, scathing. But Sachin has a different view. And I should say that I've spent a few minutes establishing rapport with Sachin because it's the first time I've met him. And I felt a little bit bad because I hadn't gotten the time to properly read the book. I haven't yet held the book in my physical hands, but the book's already been out, so we need to get this interview out. Part of the rapport with Sachin is that he has a similar educational background to me. I wouldn't say exactly the same because he comes from a different university, but I'm looking forward to exploring the world of private equity with Sachin. And before I go there, why don't I allow Sachin to say hello to you and to correct anything that I've messed up so far. Go ahead, Sachin.
Hello, everyone. It's a pleasure to be here with Guy and his audience. Everything you've said is just fine. There's nothing to correct. And I'm looking forward to our discussion today.
Yeah, and so why don't we just start with a very brief introduction of who you are and how you ended up having the career that you've had, which has basically been at the very center of the evolution of private equity from the world that it was to the world that it is. And so perhaps you can tell us a little bit about your career and also the world of private equity that you've operated in over the last 25 years.
Sure, it's a pleasure to do so. So I started life as an investment banker in my career and as an analyst and an associate at Morgan Stanley and worked on Wall Street here in New York, where I am now. And during that time, 5 year sort of period, I had a number of offers from private equity firms. This is going back into the sort of late 90s to early 2000s. Firms like Carlyle and other firms, good firms. And I chose a very entrepreneurial opportunity with a bunch of guys that came out of a market that's not traditionally associated with private equity, which is Australia. And they had this great idea, which is we're going to create this sector globally called infrastructure, because we've been doing it in Australia. No one's heard of us, and we're going to do it globally. There was equity involved, and it was a very interesting proposition and super entrepreneurial. And what I liked about it was you didn't have an established brand name to rely on. And it was really just kind of you, the team, a phone, a laptop, and a desk, not even an office. And so I did that for 5 years and was part of a team that really created this sector called infrastructure, helping everyone as one of the team members to do some of the very early deals in what is now known as infrastructure, which is a gigantic area of private markets. And then moved into what I would say is more sort of, traditional private equity, doing buyouts and distressed. I was working in a firm called Apollo, where I got to partner, pre-IPO partner. And then after the IPO, I stayed for another fund. Then I retired about 5 years ago from the firm to start my family office. And I now invest directly in private equity. I have a hedge fund as well. And I also am an LP across several private equity firms, so Carlyle, Blackstone, just Silver Lake, also some Goldman Sachs funds. And so the perspective I have is of someone who, is working on the GP side. In other words, the private equity firm side has now gone, I would say, independent, not selling anything to anyone in terms of investment products, and is now invested across several private equity firms. That's basically the career in a nutshell. And of course, in the pandemic, a lot of which I was spent in beautiful Switzerland, not too far from you, Guy, in Zurich. I wrote a book, and this book is what is the sort of inside story and what private equity is really like. It's constructive on the industry. It's called 2 and 20, and the subtitle is How the Masters of Private Equity Always Win. And what that means is, how I've seen the best players in the private equity world perform. What's really driving them? It can't just be the fee formula, because everybody has, this kind of 2 and 20 sort of structure. how come some firms can beat the market, get ahead of the market, and some firms cannot? What are the characteristics of success? And the reason I think that's particularly important is because right now, private equity is opening up the investor base. It's not just large institutional investors, pension funds, retirement systems, sovereign wealth funds, ultra high net worth families. It's more going to kind of the mass affluent, and slowly, as regulation changes and allows and the products are adapted, more and more people are going to have this choice of whether they put a portion of their investment basket in private equity. Let's say before, people used to say, Guy, let's put 60% in stocks and maybe 40% in bonds or something like that. Well-established kind of rules of thumb. I think going forward, we're going to be looking at people putting maybe 10%, 20%, maybe 30% of their capital. They're going to allow it to sort of be locked up, so it's illiquid. But on the other hand, if they pick the right firms and the right funds, they will hopefully get a superior risk return outcome to add to their basket of opportunities. And so when you're a retail investor, or when you're not working in a massive investment firm, or let's say you're a successful entrepreneur, whether you're a tech or industrial or chemicals or whatever, and you suddenly, your wealth advisor comes to you at UBS or Credit Suisse or whatever, and comes to you and says, well, I got these private funds, do you want to put some money in? A lot of the times you don't really know. And you say, well, I'm going to rely on the suitability report. I'm going to rely on some advice, but this is active management. It's not ETFs. It's not passive management. How do I really know? And so the idea behind the book is to sort of teach people what are the characteristics of success, which I think are relatively common across the best firms that I've seen. And that's really how we get to the book.
Yeah. And it's and I would tell you that parts of the book that I've read properly, I've enjoyed the kind of bird's eye view. So Sachin takes the reader into conference rooms with the partners of the firm, and the discussions taking place both on deals that are good and deals that have gone sour. And I think that you transmit the atmosphere extraordinarily well. And I think that my experience has been that just knowing what it feels like to be in the room puts you ahead of the game in 1,000 different ways when you're dealing with people who've been in the room and where you didn't really have the chance to be in the room. I just wanted to ask you, I imagine that the firm in Australia would be Macquarie, because but you didn't mention their name. I'm curious. I hope I haven't done anything by mentioning their name, but.
No, I mean, the firm I work for, it's a fact, it's a historical fact. Yeah, I did work at Macquarie, and I have the highest of respect for them, as I do for every firm I work for. I think they're outstanding people, and it is true that they did kind of create and spearhead the structure. There are other people doing it, but the people who really spearheaded this globally was Macquarie, and I think they've done a fantastic job. And look at the size of infrastructure today; it's enormous, right?
And just to, there's a chapter in my book, the second chapter, I talk about the perils of an elite education, and you certainly had an elite education. I'm curious to hear from you whether you think that what you studied at Cambridge helped you, or to what extent it helped you or hindered you in your career.
I think, look, I read economics, and I wrote a thesis in volatility and risk in mature financial markets for equity and debt capital. And I looked at how patterns of volatility are actually declining as opposed to increasing. And I was looking at kind of moments of distributions, the fat tails and asymmetry, leptokurtosis, all these kinds of concepts. And I think perhaps in a slightly more abstract sense or analytical sense, those things help. But it's not finance. It's not like I went to, one of the American business schools where you're actually learning Excel and you're learning how to build an LBO model and all those sorts of things. So I think it was very useful kind of, economic background when you're thinking about the macro environment to invest in, and you're thinking about interest rates and inflation and unemployment, all those things. But it wasn't, directly applicable in the micro sense of how you actually do deals. That all had to be learned on the job. And, we talked about Macquarie, but one of the great things about working in private equity, whether it's infrastructure or buyouts or distress, which I've done a fair amount of, is that, every deal is different, and you almost start sometimes with a blank sheet of paper. And it's about how you model the situation, how you think about the situation quantitatively, qualitatively. So I would say that an education at a good college, university is always helpful. I found it very helpful as background, but it was no substitute for actually learning on the job. And that's why I was lucky to work with very good people that were kind enough to teach.
I think that my experience is that some universities, but many, not many, they do something with, it's either through selection or through what they do with the students, and it's not restricted to certain two British universities. It gives the individual the confidence to draw their own conclusions from a set of facts that they've been looking at, which is an utterly key skill. And as I sat in my Harvard Business School class, and subsequently, I think that there were very clear personalities, people who could do that, and people. I mean, I hate to be undermining, but they were kind of waiting to find out which way the wind was blowing, or being told what to think, and it's that capacity to draw conclusions on your own. But what I would also say is that both from my undergraduate experience and from my business school experience, there are individuals who have fine minds, but somehow that elite experience handicapped them because they kind of get stuck. They got stuck in a certain mindset, which clearly you have not done. But and I'm just curious if the conclusions I'm drawing from my education are anywhere near the conclusions you draw from your education.
Those very deep comments, and look, I have a lot of sympathy with that. I agree with a lot of what you're saying. I mean, the career that I chose, I think in many ways you've chosen, is really a people business. And it's not passive investing. It's not run by artificial intelligence or quant. It's really judgment and relationships. And you have to have the empathy and the humility to realize that the vast majority of the day-to-day work on deals is actually being done by somebody else. It's being done by the management teams, the folks on the shop floor, the people who are punching in and out, whether it's 9 to 5 or 9 to 9 or whatever. And your work, although intense and critical, at the board, in between, more importantly, board meetings, working side by side with the C-suite and the next level down, and in many cases, the next level below that too, you're really in a sort of symbiotic partnership. And so trying to understand people, relate to people, is hard. And if we look at the book, I should grab a copy of it at some stage. We kind of go through chapters in this book.
That's the first copy I've seen. Do hold it up because this video will go. There you go. There you go. Yeah.
And I think it is.
And let me see the spine.
Spine. Yeah. There.
And is that the famous? I was looking at the building. Is that the Seagram's Tower?
It is the Seagram building, actually, an iconic building here in Manhattan, and a building that I may or may not have worked in for quite some time, and a lot of fond memories there. But what we do in the book is we go through chapters that basically peel each level of this down, break it down. We go through key principles that I think are common to the private equity firms that I've seen that keep winning.
Yeah.
And when I'm looking at making an investment, whether it's a direct investment or whether it is an LP investment, I look at all of the factors that are in the book and maybe a few more as well. And I kind of wish more people would. And I think that would be great. The more educated the investor base is, the better it is for the industry. And if that means that the better firms just keep doing better, and the ones who are not performing as well as possibly they should, kind of change their ways and hopefully sharpen up, that's a good thing. Because at the moment, I think the funny thing is, Guy, there's a lot of people who still think private equity just doesn't work. Like it's some kind of, it's a sham, or it doesn't, it doesn't create any value. And I mean, this industry is a $12 trillion industry, private markets, of which private equity, the most famous part, is about 7 trillion. It's doubled in the last decade. It's probably going to be more than 20 trillion by the 2030s. And, it's not paying paper returns like a hedge fund, it's paying cash.
Yeah.
Cash goes in, cash goes out. And those pension funds, retirement systems, sovereign wealth funds, they're receiving real cash. And so, it obviously works. The question is whether the experience of any individual investor is satisfactory, because relative to their expectations and relative to the fees they're paying, are they getting a good enough outcome? And that's why we're trying to go through these factors you talk about: lateral thinking, empathy. I talk about something called the paramount importance of temperament. These guys are in long-term investing. It's not day trading. It's not hedge funds. It's not something that you're flipping from one year to the next. You're probably holding on to these assets for 3, 5, probably more like 5, sometimes 7, sometimes 10 years. And so these sorts of characteristics that we break down are what I think investors should look at in a qualitative sense, in addition to looking at whether the numbers are good enough when they're deciding to place their bets.
Well, let's dive into some of the mechanics, and you're going to be bringing me perhaps along a learning curve, and probably the listener as well. I have spent an enormous amount of time in the world of Berkshire Hathaway and Warren Buffett, and actually that's what drew me into investing, from an investment banking job that would have been very, very different to yours. And there's a famous bet that Warren Buffett took with. In this case, it was an investor in fund of funds. So let's just be clear, this is not private equity. It's not the things that you're talking about. But Warren Buffett's basic idea was that if you've got, in his case, 2 layers of fees, so you've got the underlying funds fees and then you've got the fund of funds fees, then you're unlikely to beat the index. And so Warren Buffett took the side of the index, and this other investor took the side of a fund of funds, apparently well-known fund of funds, and it ran for, I think, 5 years, and the investor lost. I think that in the fund of funds that was picked, the fee structure would have been something that was layered on top of a 1 in 20 hedge fund structure, which might have come out somewhere to a 2 in 20. And 2 in 20 is a very, very significant amount of money. Anybody can run a spreadsheet to show that if you shave off 2%, just 2% of the returns in any kind of compounding machine, you're actually taking an enormous amount of money away from the investor. And for your interest, Sachin, my CFO wrote a white paper about zero management fees, those fund managers who don't charge, and this is again public equities, but they say, which I do, is I'm not going to charge a management fee. I'm only going to charge a performance fee. So that's kind of like a perspective, and it's a kind of like John Bogle perspective, if you like. And then you have, you're no dummy, and what you've said, you've written a book about it, but it comes from a very different perspective. So I'm curious to hear, maybe this is the first time you've heard this question, maybe you've heard it before. I'm curious to hear how you respond. And, can these two realities coexist? Is one right and is the other wrong? If they can coexist, where's the one right and where's the other one right?
It's fantastic set of questions there. Look, I think we need to get away from this idea of thinking about, is private equity a good thing or a bad thing? Is it black and white? We also need to get away from looking at the industry as a whole. We don't look at all of the media as a whole, or I don't think we should, at least. We don't look at all politicians as a whole. We don't look at all pharma companies. Take your industry, take your topic of interest. You actually need to be a little bit more nuanced and subtle about it. We certainly don't look at all insurance companies in the same way. Whether it's the terrific, venerable Berkshire Hathaway subsidiaries, or it's your local insurance company, I guess, in Switzerland that does healthcare or whatever. And so you need to break it down. And I think there's no dispute that as an industry, it delivers. It wouldn't exist. It wouldn't be growing as quickly. People would not be going back to it, re-upping commitments if there was, there are no results. I think that's just fact. The question is actually different, which is it value for money? And as someone who's self-made, and as somebody who cares about value for money, as I'm sure everybody listening in your audience does, that's really where I get to, which is, what's the best value for money? I don't think you want to put everything in public equities, or everything in real estate, or everything in private markets. You want to have something of a balanced portfolio, whether you're a pension fund or whether you're running your own pension. And so the question is, if you're in public equities this year, you're not feeling that great, right? You may have gone up a lot after the pandemic, so-called after the pandemic, but this year has had other shocks that's probably taken you down again. And so I think you need to look at individual sets of funds, firms that you're investing in, and whether they are able to deliver a higher return per unit of risk they're taking on. Right now, there are some funds, I think, that are not buyout funds, which are a great place to be. They're actually giving you returns in the teens. But the band of outcomes on those returns is quite narrow. The chance of losing money is exceptionally low, I think. So the downside is limited, but in return, you're giving up some upside. What kinds of funds are these? These are things like hybrid funds, tactical value funds, sort of structured equity, kind of that hybrid between debt and equity. These at the moment, with the macro environment we're facing, the geopolitical shocks we're facing, this is a good place to be. But a lot of those charge 2 and 20s. You might say, well, how come you're charging 2 and 20 for something that's giving me 15 net of everything? But that structure should be applicable to a fund generating 25% and doing distressed or buyouts or whatever. Well, look at the band of outcomes where you're likely to come out. You're probably going to come out with very low chance of losing anything, but you're kind of quite narrow in that sort of quite specific tunnel of where the outcomes are. If you get that fund right and you realize you can't replicate that anywhere else, putting a bit of your money into that as part of your portfolio, as we discussed, it's not about everything in one basket or another. It's not even about, I think, going forward, just stocks and bonds. The investment menu is growing. And as that plate of what's on your menu grows, you should look at lots of different products and see which ones make sense for you. In this case, if you're putting money in private markets, remember it's illiquid. You've got to ask yourself, the chance of taking out when I want to is probably very low, if not zero. And so how much money can I really afford to lock up? That probably sizes your investment just there. Saying, well, I can't afford to lock up more than 5, 10, 15, 20, whatever it is, percent of my capital at any one time. So I'm not going to put all of my money into this. And it's not the comparison between, do I do all of this or all of the other? And so the reason we've got into that dynamic of who's beating who's beating the chest and all that, is because we're in this sort of adversarial, antagonistic mindset of, is she better? Is she better? Is he better? Is he better? They're all offering different things. And the kind of, I think the disciplined, sort of perhaps neutral, the Swiss way of looking at things is probably to look at all of the options you have. And so specifically on fees, if you've been paying 2 and 20 to a fund manager for a very long time, and they can never beat the S&P or whatever index is relevant for that product, you're going to be asking some questions, right? I'm not saying you're going to be pulling it out straight away, but it's fair to ask, how come I'm paying so much more in fees versus an ETF or mutual fund or whatever, and I'm actually not making those returns? So that's why I try to focus people on the better firms, the better funds, and what you should be looking for, the traits and principles you should be looking for. So when you make that choice, you're making a more informed choice. And so you can ask yourself naturally, am I being adequately compensated for the risks that are being taken on my behalf? If I'm going into a high yield fund and they're taking on 12+% risk in companies issuing high yield, but I'm receiving 6 and they're charging me 2 and 20 or 1 and 10 or whatever, I'm going to be asking some questions where who's actually taking the outsized risk here for the narrow return? And that may not be the case, right? I'm not picking on any particular sector or fund, but I think the more informed we are, Guy, the more we need to look beyond this kind of this race of, is it one versus the other? And you probably end up in a place where you have a little bit of the market, and if let's say you're all going long, you're not shorting anything, you have a little bit of the market, you have a little bit of private funds, you have a little bit of real estate, and that kind of makes sense, right? Overall.
So I think that if you were in a panel, I think it's the late John Bogle. He would just say, "Yeah, that's great. I just go for the lowest cost option," which is another. You're kind of saying, "Hey, what are you getting for the risk that you're taking?" And you want some of each. And actually, Charlie Munger would say the same thing. But I want to move on to a different question, and I appreciate your response. So I've spent, in the world that I'm in, looking over my shoulder at these burgeoning tech businesses coming out of California, Silicon Valley mainly, and the extraordinary innovation, the way software is eating the world. And it turns out that there are really, there are a number of excellent venture capital firms, and I'm not here to ask you about venture capital, but it's the structure of the industry that's interesting to me, is that, and Charlie Munger's talked about this, that the overwhelming majority of the returns in the industry, in the Silicon Valley innovation industry, have accrued to two firms, or investors in two firms, A16Z, Andreessen Horowitz, and Sequoia, and there are a number of others. So forgive me if I haven't mentioned them to you. And there's a phenomenon by which those firms get the best deals, and because they get the best deals, they attract the best partners and they attract the best resources. And these are firms that are way more than just allocators of capital. They actually structure around the entrepreneurial companies to help them to grow. And if you're a company that's seeking funding with a new idea, if you can get in with one of those firms, it makes an enormous amount of sense. So it's a virtuous circle for those firms. It means that if you're in some way on the inside of those firms, either as an investor or certainly as a partner, then you're going to do extraordinarily well. But if you're a guy or even a well-funded firm that wants to set up in the Silicon Valley ecosystem on the edges of that system, you may not do nearly as well in any way, shape, or form because you have to be at the center. There is another industry like that, which is the movie industry. In the movie industry, the vast majority of movies don't make money, but the Hollywood blockbusters do. And to work your way into the center of that industry, whether you're an actor, whether you're an investor, whether you're a studio, is a work of decades. And then the ones at the center sort of rake in an awful lot of money, but if you're an independent filmmaker, you don't make so much. And so it's interesting for me, I regularly receive decks from people who are setting, or maybe not so much now, decks from people who are setting up venture capital funds. And there are various claims to greatness, but at the end of the day, somebody from the outside can say, you're not Sequoia and you're not A16, and the world is unfair in so many cases when it takes all. So back to the industry that you know well, it seems to me that there's a similar phenomenon developing with some of the firms that you mentioned, Apollo, Blackstone. The winners are winning, but if you're not with those winners, and they probably do have very, very good returns, but if you're not with them, you may not do as well. I'm curious if that's
I don't think it's quite the same, because there are plenty of smaller firms that have grown and in fact are growing and are not necessarily in the limelight that are outstanding. Remember, it's a people business. And so if you have fantastic people who are not working at those large listed firms, but they're running great funds, they could be relatively small funds, $1 billion, less than $1 billion per fund in private equity terms. It's kind of on the smaller end. But they're making amazing returns. And the question is not whether they're good or bad. The question is, are you going to serially back them? Because as they get bigger, potentially they may not get bigger. They may want to stick at a certain size. Can they replicate that success again and again and again? And so what the larger firms have done, essentially the listed ones, they have proven that through market cycles, because they have maybe 30 years of data each or more in some cases, that they can still do it, even with leadership changes, even with the next generation of leadership stepping up. And that's really how they develop what I call a moat around the business. They have this network effect. They have phenomenal data and intelligence. There's a chapter in the book called The Library that I say, is very important to read. And it's about how private equity firms are building incredible knowledge, totally, obviously legitimately managed well, all those things. But building up knowledge on lots of different areas of the economy so that when a deal comes along, they can look at it from lots of angles. They may have owned a supplier or a customer or a competitor or all of these before. So they have a great lens or series of lenses. And so, the larger firms have that track record. They have this data and intelligence. They're using sometimes data science to improve it. And it's hard to suddenly replicate them. That's what's hard. But that doesn't mean there aren't terrific opportunities. I mean, I put some money to work recently in a much smaller fund that I actually hadn't heard of, but I took a good year to get to know them. I went to see them. And a lot of people, may or may not have that opportunity. But I was, at the beginning of the wealth managers were saying, we've introduced you, the deal's closing, you got to put this subscription in. I was like, well, hang on a minute, I'm not going to do that. It's fine. If I miss this fund, I'm going to look at the next one. If they're that good, they'll be able to do just as well in the next fund or thereabouts as this one. It won't be a one-time wonder. And so, you do get the phenomenon that it's hard to suddenly replicate the biggest and possibly the best in some senses. But there are amazing firms out there that are not there. And some of those firms are, doubling in size every few years because there's so much demand for their capital. Some of them are sector focused, software, whatever, technology, some, life sciences and so on and so forth. So I don't think it's exactly the same. But you do have this dynamic where there is, a sort of breakaway set at the very top who are probably at this point quite hard to replicate, given just they're past that tipping point of, they always see the deals, they're a certain scale, and, they just kind of move past, they're what I would call the sort of, we all know the big tech firms, right? We all know Apple, Microsoft, Alphabet, Google, obviously, going to consumer, we go to, Amazon, Tesla. These are the equivalent of those firms. These are big finance in a good way. And so you do have all those firms, but you equally have much smaller firms that are doing very well and people should look at. And that's why in the book, I try to teach people about these are the characteristics I look for. Do you find any of those when you're looking for other kinds of funds too? And if you don't, then factor that into your decision-making.
So I want to dive into some sort of like, so I have been exposed to the industry through kind of not random, but it's sort of like I want to look at the industry and ask you specific questions through the lens of sort of my experiences, which are very, very specific, but might be fun. So, and I'm going to start with, you mentioned Silver Lake, and I've had a small investment in my fund in Twitter where Silver Lake had 2 board seats. But at the same time, when, and I kind of said to myself, I didn't know a huge amount about Silver Lake, but I said, these guys are people like just Sachin, smart, rational, all these good things. And I kind of, 2 things. One is that as I owned the investment, I discovered that there was a huge amount of technological debt that they didn't seem to be addressing. The second thing was that it seemed from the outside that there was some really key decisions that somewhere between Jack Dorsey and Silver Lake and the other directors, they weren't going to get to make. And so when the Elon Musk offer came through, it seemed to me from the outside that they kind of put up their hands and just said, yeah, we'll take it. Because I would have imagined somebody of your background, and I'm imagining it's somebody like you who's running the investment at Silver Lake, would shop the deal. And they didn't even shop the deal. So it was interesting to me because I kind of had the perception of them being, I think that somewhere in the book you talk about hyperactive attention to detail from the private equity firms as they manage these investments. And I kind of imagined that to be the case. But then what I saw emerging from the offer was that was not the case. So I'm wondering if, without, I certainly don't want you to talk about anything that's in the private domain, but can you help me interpret the data that I've interpreted one way? Perhaps you have a different interpretation, or maybe I'm missing something, or maybe I'm accurate. I'm curious to hear your reaction.
Yeah, look, sure. So, obviously it's very important I don't talk about specific firms or people or funds. But I get what you're saying. And I think what's important in what you're saying is you're relaying your experience. And, that's something that everyone should respect, which is that's your experience of private equity. So may I ask you, what was the return that you achieved on that investment in the end? Just setting aside for a second, your concerns about how the deal was run and so on and so forth.
It was I mean, I mean, I think the investors right now aren't sitting on a very good return from the price that I invested, but I had about an 80% return in 2 years. So it was a successful investment.
Right. So, and you did no work on that deal. And that's 80% net of fees, or is that gross of
That's
fees?
a gross return, because to go into it all gets into a portfolio, and but you can call it. I mean, so net return 60%. It was still a good return.
So
sorry, Sachin, I just have to tell you the idea that I did, maybe from a private equity perspective, I did quote no work, but I felt like I was doing work. But I understand and accept and appreciate that it's not the kind of in detail, intensive modeling, channel checks. I do that, but let's say I do it on a much more selective basis because I have far fewer resources, because I charge lower fees. But yeah, go ahead. I'm feeling defensive, but go ahead.
But on the deal that you were in, and we're going to anonymize everything because we don't want to talk about individual. It's not the right way to do it.
Right.
But anonymizing the whole thing, you were in a deal where you were a passive investor in.
Yes. I was along for the ride. Yeah. Outside passive minority investor.
Right. Okay. So probably on the lesser end of work that you've personally done on investments through your career.
Yes.
Let's put it that way.
Yes.
And you made 60% net of everything in 2 years, you said.
Yeah. Isn't that great?
Right. I'm struggling. I'm trying to locate the source of depression here.
No, not depression at all.
But let's stick with it, and we may be able to isolate your why you're depressed about it. But anyway, and so you got your 60%.
I'll take a pause for a second. So part of what's going on here for the listener is that I think, Sachin, you're tapping into a British thing, because Sachin has multiple identities like me. He's lived in multiple countries. And what he's doing is he's being in a friendly way. He's being very friendly, derisive. And because he spent enough time with me, he knows I'll respond positively. And I'm really enjoying it. So feel free, go ahead. Yeah.
so what I'm getting at is, let's not make it about you. Let's make it about me. So I put a passive investment into something, and these guys come along. I may have concerns about how they've done their work, but I've made 60% on this, on the lighter end of work that I've ever done within 2 years. But I still, and we should all respect this, have legitimate concerns about how they did their work, whether they shot the deal, and blah, blah, blah. So on this anonymized deal, it's very hard for us on the outside to check whether any of that is kind of really true, right? And so whether the deal was auctioned and so on. And what you'll see in the book is that the chance of that just being kind of a bunch of accidents,
very low,
I think is very low. And so what probably happened on any deal where you have these concerns on the outside, first of all, it's a shame you didn't get a chance to engage and talk about it with whomever managed that investment for you, or maybe you went through a bank, or whatever.
Well, Sachin, I had not met you, and you had not introduced me to the people at Silver Lake. But maybe if you still like me at the end of this call,
I'm certainly not the person to sort of make introductions. I don't want to set myself up in any way, setting that out as if that's true.
No, you're right. You don't. But I was trying to set you up. That doesn't stop me from trying.
Good for you. But the point is more that, what I've seen, and this is where it now goes to my experience. So your experience was a great financial experience, but you had troubling, or
No, I wasn't troubled. I wasn't troubled at all.
But you had questions. You had questions, right?
Yeah.
And so you felt
Unanswered questions.
unanswered questions, right?
Yeah.
So that was a sort of not sure what happened there, but I'll take the 60% and move on.
Yeah.
And so for me, when I look at things on the inside, I look at it and I say, what is my experience of situations where maybe not everything went well and they ended up being a good exit? The truth is, what I've seen is unbelievable focus.
Yeah.
Okay. Unbelievable.
Yeah.
Because going back to the incentive structure, in private equity, you are not a advisor, you're a principal.
That's
right?
why you got out of investment banking,
Not an advisor.
Yeah.
And a little bit is personality type. Some people are outstanding advisors and they could make very good principals, but they may prefer or be better off as an advisor, with a collection of deals and then moving on after they close and staying in touch and all that. Some people are just naturally more principals. And I think that when you are more of a principal and when you're incentivized as such, in other words, you eat what you cook, you're incentivized on the result for Guy, for others. You look at all that and you say, I'm not going to have less control of this if not everything is going well. And it could be any situation, right? I'm going to have more. You devote more of your pie chart of time on portfolio management. Now, it doesn't mean it's going to work out in the end, but you're definitely trying.
Yeah.
And you could end up trying for a decade of your life on a deal. And you don't want to spend a decade of your life on a deal where the best you can do is return the investor's money and make no return for yourself as well, and no return for them. You want a return of the capital and you want a return on the capital. Yeah. And so, what I've seen is amazing focus. And I sort of think that, obviously, you can't, if you were sitting along the ride for every single deal, you'd be working there, right? And so there's a difference between one and the other. But I think what the major firms have actually got very good at doing, and it's probably a more recent phenomenon than the deal that you're talking about, is that if you're an LP, the communication is actually really good. In some firms, like Blackstone, for example, I mean, the memos and everything they send you on deals, and it's outstanding.
Really?
It's outstanding.
Really?
They really stand out.
Yeah.
And, considering that as an LP, you're a passive investor.
They have no obligation.
Well, no, they do have an obligation, but it's just, I think they go above and beyond. And so, you look at the disclosure today, you look at when you attend conferences and, they're talking about their deals, and I'm not going into any detail, just in general, they're providing very good disclosure. And what you'll find if you're an investor in these funds is that sooner or later, you will get quite a good summary of what happened on the deal. And you may not get, what happened in the boardroom or whatever, but it's kind of less relevant in a way.
Yeah.
What's most important to you is that, are they performing? And so if, 60% return in 2 years, or whether it was 50% or whether it was some other number, 100% return, doubling your money, these are very high returns, right? And so, the public markets might give you that, and then they may take it away. And, are you smart enough to sell exactly at the top and buy exactly at the bottom? And so, I think the lesson here is, what they're doing is it's kind of like hand-to-hand combat, right? They're blocking and tackling, as we say in some of these sports here. And if something's not going right, they're going to try and pivot this way, do this way. They're constantly looking to say, how do I achieve that outcome, the band of outcomes that I discussed with my colleagues and peers when we approved this deal? How do we do, we may need to move along the way, but how do we achieve that band of outcomes we're seeking to achieve? And I think you have to sort of trust that process and realize that the reason they're growing so well is that it generally works. Now, of course, if you're invested in a firm and funds where you're not getting the returns, then you're going to ask more questions. But I've seen in my experience amazing focus by these guys when they're in stormier waters, right. Even more so And the way I sort of think about it, to use a sporting analogy, is they're very good at playing offense. They're very good at attacking. They're very good at running forward. They're generally exceptionally good at defense, which is when they start to worry about something going wrong, possibly even a loss of money. It's not venture capital. It's not like you're expecting a few to blow up, a few to be the next Facebook, and then some kind of in between. You're genuinely trying to make money on every single deal. And that's why I think as a portion of your portfolio, it's important to think about this as a possibility alongside public markets and things like real estate.
So I'm going to take you into a different part of the industry, and following your lead, I'm going to anonymize my experience and talk in general. And I'm going to talk about, I'm going to talk about a company that I looked at, and there's a pattern. I won't name the company. There's a pattern here that you can maybe elaborate on. So in the distressed debt field, what I see, so distressed debt and bankruptcy is a fascinating area because, you could call it the corporate graveyard, but is actually the corporate recycling arm of the capitalist economy. And I think that many of us underappreciate how efficiently that operates in the United States and other well-functioning capitalist democracies, and the speed with which capital gets recycled. But there's a phenomenon where a private equity firm, well, actually, so many examples I want to give. I am going to give examples, Sachin. So one company I came across was GNC Stores in the United States. And the phenomenon is they get loaded up with a bunch of debt. And that is done in conjunction usually with an investment bank. But there's usually a private equity firm behind it as well. And then it's kind of like up to the equity becomes increasingly a stub. And often the investors in the equity are not aware that they're slowly becoming owners, not of the firm, but of a call option on a potential extraordinary future. But what the distressed debt investors in conjunction with the bank are doing is they're setting up the kind of like the final demise of the firm, at which point it gets dragged through bankruptcy and something emerges the other side, which may be nothing. It may be a complete liquidation or... It happened recently with your former namesake. This is all public domain. Everything I'm saying is public domain, in which a very well-loved and respected or a firm that people were very excited about, Carvana, took on a huge amount of debt from Apollo. And you see this process starting to happen. It's not like they're necessarily going to go into bankruptcy, but that's what this part of Apollo does. I think that I had an experience which was very bitter for me because I did not watch the company that I was invested in as they took on more leverage in a way that I didn't really pay attention to, and suddenly I was faced with I wasn't even faced with the investors. They stayed in the background. It was their lawyers who were taking this company through bankruptcy court. And so what is my question to you? My question to you is, you touched on it briefly. Within your ecosystem, of the many different kinds of private equity there are, what kinds of people get attracted to that space? What is the future of that space? How does it feel to work in that space from your perspective? You were a partner at Apollo. They would have been partners responsible for those kinds of deals. How does it look from your side?
Distressed investing. So again, we're not going to talk about any specific firm or business or deals or people. But, I think that going back to the book, one of the traits of success I've seen, and it manifests in lots of different ways, is an attraction to complexity. Now, that complexity could be the complexity associated with understanding a nascent technological trend, or unpacking the science behind a life sciences deal like a pharma discovery, or something else that has some technical complexity. Or it could be the complexity that you find looking at a balance sheet. Could have a good company with a bad balance sheet, or a company with a balance sheet that's getting worse, or a bankrupt company, and so on and so forth. And so this attraction to complexity is what I call in the book looking at complexity as a source of value. And I don't think there's a particular DNA or mind or personality that goes for one kind of complexity necessarily over the other. You might find somebody who has more of an aptitude towards technology deals, or an aptitude towards healthcare, or an aptitude towards, more sort of financial analysis that's across lots of kinds of deals, as you find in distressed investing. And when you think of it that way, when you look at complexity as a source of value, then you start to look at, going back to distressed investing, this is one transaction pathway that gets investors to the result that they've been promised, they've been sold on, they've bought. And who are those investors? Let's go back. Those investors are pension funds, retirement systems, sovereign wealth funds, increasingly retail. Those are people that have bills to pay. Those are organizations that have obligations. So they're looking for financial returns that complement the rest, or enhance maybe the rest of their portfolio. Distressed investing is something you can't just pick up in an ETF. Okay, it's one of the most active types of investing there is, and it applies equally to lots of other kinds of private equity and private markets, whether it's credit or otherwise, or infrastructure. And so, you have to look at an inquisitive mind, curiosity, attraction to unpacking problems, all of those sorts of things. And you could say, well, that exists in lots of spaces. Well, it does. But in this sense, that trait, that principle, has to coexist alongside all the other traits that I think are factors in the success of the best private markets firms, private equity firms, such as temperament, such as incentive, they eat what they cook, and all those sorts of things. And let's now unpack that a little bit and maybe contrast it, Guy, with life today for most of us. Most of us are not looking for complexity. We're looking for simplicity. There's an app for that. There's a hack for that. This is easy. That's easy. Most of us are looking for a shortcut. And we're used to it, thanks mainly, I think, to technology. And so what this mindset is exactly the opposite. They're looking at a difficult situation where the value might be hidden to most and say, well, hang on a minute. The underlying assets here are actually worth something. It might take an enormous amount of work. It might take us years of patience to unpack this, dissect this, and so on. That's not something an index tracking fund can do. That's probably not something a lot of hedge funds can do.
Yeah.
And so what you're looking at is the opposite of the kind of modern convenience lifestyle, download it, use it within 5 seconds kind of stuff that we're all used to. And you want that. You want some part of your portfolio focused with folks who love doing that, who just love it. And that's, that sort of complexity, I think, applies not just in distressed investing, but elsewhere. Second point I'll make, and I'm conscious of time as well.
Yeah.
Second point I'll make is when you don't pay much for something, whether you are a Swiss real estate magnate and you're buying properties out of auctions, or you are a private equity firm that is acquiring assets out of restructuring on behalf of your pension fund, firemen, teachers, blah, 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 investors, you're not going to put that much debt on it in the first place. You haven't paid that much for it. The lower your purchase price in terms of the multiple, let's say, more likely than not, the less debt you're actually putting on it as it emerges from bankruptcy. If you buy everything at 10 times and you lever it at 7, then you're reasonably reliant on multiples not crashing down to 5, right? If you generally buy most things at 6 times, you're not levering anything at 7. You're levering it at 3 or 4, or maybe even less. If it's a technology deal, you may not lever it at all. And so we need to look at, just because it's involved with debt doesn't mean that it's inherently over leveraged or risky or bad. We need to look at exactly what is it. It might be buying a good asset out of a bad situation, putting less debt on it, and deriving a good return. Often the distressed investments have quite a good band of outcomes where the chance of losing investment money is quite low. They haven't paid much for it in the first place. There may be a good interest rate involved, depends on the situation. And often the returns are quite strong. Now, would I have put everything in my portfolio in distressed investing? No. As the economy goes south, possibly, we're looking at the next 18 months, 24 months. Do I hope that a number of the private equity firms that I'm involved with have given money to are looking at distress? Yeah, I hope they are, because there may be some good things there for them to look at. Let's also remember, and this is the final point I say on this, when something is already distressed, Guy, it's on the ropes. All those jobs, they may already be gone.
Absolutely.
And if there's nobody there, if there's no government to pick it up, there's no savior to magically restore everything back to the glory days, the result could be zero. The result could be losing everything, shutting down all those factories, losing all those jobs, absolute zero. And so you want, in that situation, someone coming along and saying, is this salvageable? Is there a good company underneath this bad balance sheet? And that's really what a lot of this is. And once you look at it like that, whether it is it's a consumer goods company or it's an airport logistics company or whatever it happens to be, you start to look at it a little differently and saying, it's a little bit like a rescue in a lot of the situations. And maybe this company wouldn't exist if it wasn't for this investment. Could the company look different? May it have a different headcount? Maybe net has a higher headcount, maybe different people, but maybe it was the only way. And the alternative was there'd be nothing.
And I would tell you that in bankruptcy court, what puts the fear of God up onto any bankruptcy judge's desk is the fear of administrative bankruptcy. And often the distressed debt funds that are in there, one of the kind of it's almost like an unwritten understanding is that no matter what, this is not going to be an administrative bankruptcy for the judge, which is very, very hard, meaning that the company's hasn't even got money to pay the legal advisors to bring it out to some other state where it's not a ward of the court effectively. I would tell you complexity is good in the hands of somebody who's capable of understanding, managing, processing. And I think that the vast majority of even investment brains ought not to do complexity because there are 1,000 different ways to get your head handed to you on a plate, if you like. I think that I would have. There's another element. I'm going to ask you two questions. The first one you can pick up if you want, but you don't have to. And then the last one will be the final one before we have some closing remarks. There's another area which I've just seen and observed, and where private equity gets involved in actually investing in and growing a business. There's a well-known example here that I keep getting reminded of, a company called Breitling, which I think it was owned by CVC, and they're taking every penny that they make for now and investing in the brand and doing extraordinary things with the brand. They've got an amazing CEO who's a genius, in my opinion, and I have no connection to him at all, other than that I've seen that he's the CEO. And he's repositioned the brand and is developing it in ways that are new and special within the luxury goods industry. So that's a whole other area. Aside from distressed debt, we didn't even discuss infrastructure. But the second question, which is towards a close, is that when I speak to you in part as somebody who's grown up in part in the UK, as somebody who's now, I believe your primary home is in the United States, but not solely. You're a person who clearly has roots in more than one continent. I would be interested to hear you talk about that and talk about how that distinguishes you perhaps from some of your colleagues from within the private equity industry, and how you see your identity when people ask you, what are you, where are you from? How do you respond to them?
It's nice to end on a brief question, Guy.
That's your next book, Sachin.
Look, I actually think the truth is that pretty much everybody I've met in private markets in the last 25 years, whether I was initially a junior banker working on deals to advise these kinds of firms, or then a junior investor and then moving up, working in these kinds of firms, they all have a very good international appreciation, because that's often part of their personal makeup and that's often part of their professional experience. And so, you don't have to have lived in 3 different countries to have international appreciation. It can help, but most people who work in this industry at a certain scale, certain kinds of firms where are global firms, not just one nation firms, they tend to meet people from all over the world. And it's kind of remarkable how they strike empathy, with those folks. And the reason is they're essentially just trying to get to the truth. They're think of them as sort of financial investigators. And so they're trying to get to the answer on a particular investment, knowing that the way business is done in Japan may be different than in the UK, may be different than in the US, and so on and so forth. In German, maybe the language changes, and so on. And so I'm not sure that there's a big divide between people who have that international perspective and people who don't. I think most of them do, particularly today, because they're traveling so much and they're also dealing with people from all parts of the world. Having said that, and now making it entirely personal because you've asked me to do so, look, I have an Indian background. My parents, my grandparents, Indian heritage. And so, when I think about my heritage, it's very much from India. But have I actually lived in India? Only for very short periods of time. And, all intents and purposes, I would say I have not. And so you look at that and you say, well, then how do you feel? And you say, well, feel like a human being. You feel like, somebody who has roots in a fantastic country in the subcontinent, but also is very grateful for education and upbringing, partly in the UK, partly in the US, recently spending a lot of time in Switzerland, fabulous country. And so, I think it's never really been a question or a factor for me when I think about that. What I try to look at is not really me, but I try to look at the people I meet. And the people I meet and try to make friends with or form relationships with, or at least just have a conversation with, they're from everywhere. And as soon as you get over the concept that, you're looking at it from a uniquely this perspective or that perspective from a geographic or ethnic sense, you start to realize that you just got to have the empathy with as many different kinds of people as possible. And, that's something that I really enjoy. I love when I'm speaking to somebody, trying to pick up a little bit of an accent. Oh, is that Danish rather than Swedish? Or, it sounds more New Zealand rather than Australia. I just find that fun. Yeah. And so, to me, I'm pretty clear about my heritage, but it's not really a factor when I sort of meet people or work on investments. They can be from anywhere. And I think, candidly, that's probably the way of the future.
Something very refreshing for me about coming to New York was that I used to joke with my friends that if you walk into a Starbucks and you're a camel, as long as you could say, I'd like 1 latte, please, and you give them the money, then they really don't care that you're a camel and they'll just serve you. But I would tell you that I used to advocate to my friends that living in Manhattan was a kind of an education in humanity because there's such diversity there, just walking around and in the streets. And then I visited India, and of course I had this prejudice that I just see Indians, but in fact, India for me was even more of an education in diversity because India is just a mix of so many different kinds of people, and I think that it's one of the strengths that I understand that you did not primarily grow up in India, but somebody who grew up in India has an innate appreciation of human diversity, which would be surprising from one subcontinent, but it's a diverse subcontinent. My last question is, if somebody reads the book, which is now on sale and will certainly have links to it in the show notes, I guess you call them, and somebody wants to engage with you, find you, talk to you about buying 100 copies of your book to give to all their best friends, or they want to ask you questions, or what is the best way to be in touch with you?
That's very kind. So the publisher, the book is doing reasonably well. The publisher and I are working on a website just to gather, podcasts and comments and things like that. So that website will be 2and20.com. In the meantime, very welcome to look at my family office website, which is achilleslp.com. I'm also on LinkedIn. And I'm sure there are lots of people who contact you as well. If anyone ends up contacting you, I'm sure it'll be great to forward that on to me. But those are probably the main ways. The book website, which is coming out, my own website, achilleslp.com. There's a contact button, and I'm on LinkedIn as well. And very happy to talk to anybody about this topic, and whether it's organizing Q&As or just discussing a question with any individual. I'd be very happy to do my best to try and help.
And I would just say, as a last comment from me before giving you the last word, Sachin, is that I think that you've done a service to me, and I think probably to many, many readers, both people who might be interested in working in the field or, as you've said, invest in the field, because it is an opaque field. And the best information and insight that I have is either through a few friends from business school who have an angle, or through journalists who actually don't understand that much. And so to crack this open and create shine light where it's kind of been opaque, I think is a service to many, many people. And I think that you're courageous to do it as well, because I'm sure that there are some friends within the industry who said, no, you don't need to write about it. Let's just keep this amongst ourselves. And so I think that you've rendered a service for which I'm grateful, and I'm sure that the listener is grateful. Thank you for joining me, and thank you for educating me and the listeners, and look forward to meeting you in person at the right moment.
Absolutely. It'd be my pleasure to see you in Zurich or anywhere else. I'll just leave you with one comment, which is I think that the more educated investors are about what they're putting money into, the better that is for the people they're giving the money to, as well as obviously the investors themselves. The better it is for society. Books are a relatively cheap, accessible way to learn something about something you know less about. These days you have audiobooks, Kindle, ebooks, downloads, all of that. So there are different ways to learn, and I just encourage everybody to just read up as much as they can so they can make the right decisions for themselves. Don't wait till a financial advisor or a bank actually comes to you with a decision you have to make, and certainly don't be a passive participant in your own financial future. So thanks very much for the opportunity, Guy.
Thank you, Sachin.